Right, today I'd like to talk about the US inflation report analysis and future outlook. Okay, so first of all, let's look into the very first thing, which is the current inflation data and its implications. Now, the latest data on US inflation reveals a mixed but largely positive picture. In September, the CPI rose 2.4% year over year, slightly above expectations, but down from 2.5% in August. Now, this continues a downward trend from the inflation peak of 9.1% reached in mid-2022. Now, core inflation, which excludes volatile food and energy prices, increased to 3.3% from 3.2% in the prior month, driven primarily by stubborn shelter costs. At the same time, the PPI, a proxy for wholesale inflation, came in at a low 1.8% year over year, signaling easing pipeline pressure. So this was the result that was released last week, right? So economists and analysts, including those from Goldman Sachs, are optimistic that the Fed is nearing its inflation target. Goldman Sachs projects the PCE price index, a preferred measure of inflation for the Federal Reserve, will show a 12-month inflation rate of 2.04%, effectively hitting the Fed's 2% target. Now, this aligns with broader expectations that inflation is steadily drifting downwards, though not uniformly across all sectors. So despite this progress that we're seeing, core inflation remains slightly above the desired levels. Some factors, particularly services inflation, remain elevated. Fed Chair Jerome Powell acknowledged that while inflation has lowered shelter costs, which is the housing, are still a significant contributor, but these are expected to ease in the coming months. This suggests that while inflation has cooled, it has not completely vanished. So that is the update with regards to the inflation. So at the end of the day, I think the question begs is that, the state of inflation, is it rising or is it falling? So end of the day, the data shows that inflation is largely decreasing, but there are caveats. Overall, inflation, particularly headline inflation, has been steadily declining over the past 12 to 18 months, nearing the Fed's reserve 2% target. However, core inflation, which is a better indicator of longer-term trends, remain higher than ideal at 3.3%. So this is something that we need to take into account. Now, this suggests that while general trend is positive, which is it's gradually coming down, the complete control of inflation is not yet achieved. So if the Fed is not careful and they start cutting rates too fast, inflation could actually rear its ugly head once again. So that comes to the next step, which is the Federal Reserve's likely next steps. Now, given the cooling inflation trend, the Federal Reserve is expected to continue its rate cutting strategy, but at a measured pace. Now, understand before this, the CME, they are projecting still a 75 basis point cut. Probably that might not happen based on the data that we're receiving so far. So following an unprecedented half-point rate cut in September, the market anticipates quarter-point cuts at both the November and December meetings. The CME Fetch Watch 2 indicates a near certainty of a 0.2% cut in November, with an 86.7% chance of another 25 basis points cut in December. So that's good. It is as per the Fed's expectation right now. So the Federal Reserve course of action will likely focus on achieving two objectives: maintaining inflation near the 2% target and preventing a sharp downturn in labor markets. So despite a strong jobs report in September showing 254,000 jobs added and a slight drop in unemployment to 4.1%, Fed officials are cautious about how quickly they proceed with interest rate cuts to avoid reigniting inflationary pressures, as mentioned earlier. Now, this is echoed by Atlanta Fed President Raphael Bostic, has suggested a preference for gradual easing, avoiding any aggressive rate cuts that could destabilize the economic balance. So, end of day, further rate cuts would support continued economic expansion. and address the growing risk to employment. So as Vice Chair Philip Jefferson noted, the balance of risks have shifted from inflation to employment. The Federal Reserve must now manage the risk of weakening employment whilst ensuring inflation does not re-accelerate. So at the end of the day, economists expect the Fed to return to its usual pace of quarter-point cuts and refrain from any further aggressive half-point cuts. So with that, we know then this might, in a way, be factored into the market. Now, so the focus will likely remain on maintaining gradual monetary easing to avoid spiking consumer demand, which could reignite inflation. So as a conclusion, in summary, the inflation data shows positive progress towards the Fed's long-term goals, with inflation slowing and nearing the 2% target. However, inflation remains elevated in certain sectors, particularly in services and shelter costs. The Fed is expected to continue its gradual interest rate cuts, with a quarter-point reduction anticipated in both November and December. This is as long as data that we continue to receive in November and December still supports this view. Okay, so far it is. So moving forward, the Fed's priority will be balancing inflation control with employment stability as the US economy adapts to the post-pandemic landscape. So what we are always looking for is more good news data coming up from the US. As long as there's not good news coming out, then we can see that there is a possibility of the Fed maintaining smaller cuts rather than the big ones. Okay, so that's what we should look out for. And with that, that's the report for today. Let's move on to the charts.